25 to 5 on 2CC Canberra Live until 6 o'clock. You can call if you'd like on 6255 1206 and have your say, any topic, any time, except not right now, because right now it's time to welcome along once again from Envision Financial, Luke Smith. Good afternoon.
How are you, mate? All right?
Going really well. Now, we've got a strange setup here today, technologically speaking, because we're doing the radio show. You're on the phone, I'm in the home studio, and at the same time, we're filming the whole thing with Zoom video online. So it's all a bit confusing at the moment. I'm glad I'm not in charge of the technology.
Yeah, well, I'm not sure I'm in charge of it either, but we'll see what we get at the end of it, and we'll know whether it'll work for next week.
Exactly. It's an experimental adventure. That's what it is. Now, between now and 5 o'clock, we're continuing our series on self-managed super funds. And if I haven't lost count, I think this is episode 4 of our 4-part series on SMSFs. So today, the question is it expensive?
Yeah, look, I think this is probably one of the most talked about issues in relation to self-managed. Not only is the name rather misleading in relation to the self-management part of it, because a lot of people don't have the skill set to do this, and obviously it's not something that's right for everybody. But fees and charges, I find people make the general assumption, they jump to, oh wow, these are expensive because my friends told me so. So today we're going to talk about some things to consider in relation to, how you compare the fees and charges to other funds. Are they commensurate to other funds, and are they appropriate? And we've also got some examples that we mocked up to show, I guess, where we can change that misconception and show some real value to people going forwards.
So when it comes to comparing those costs, what do people look for?
Yeah, so I guess, anytime we're talking about superannuation, there's obviously going to be a different myriad of fees and charges depending on the fund that you're in. I've used the analogy in other episodes that super funds are a lot like cars. Different cars have different features and you buy different things for different reasons, and super funds are exactly like that. So in relation to fees and charges for a super fund, obviously could potentially be an admin fee, obviously, where that could be a scaled fee or a fixed fee depending on the fund that you're in. What you generally find is you'll have a membership fee for something like an industry fund. It could be a fixed amount. Australian Super have just introduced a new 0.04% admin fee of some sort that's getting applied to different accounts. That's a new one for them. We've obviously got an internal cost ratio, or ICR. Now, this is one that people will generally find can be a little hard to understand, because some funds are rather misleading in relation to this, because when people look in the PDS and they say, I'm in the balanced option of Fund A, it'll say the investment charge for that is 0.6, 0.7, 1.2, depending on the fund and its individual characteristics. What a lot of PDSs or product disclosure statements don't illustrate to the investor very clearly are the other things they need to add to that ICR to be able to do a fair like-for-like comparison to something like a self-managed super fund. Because some of the other things that are not well illustrated in a PDS, if you like, are implicit and explicit investment fees. Okay, we've also got...
Okay, what are implicit and explicit fees?
Well, again, pretty good question, because I actually couldn't tell you without dissecting a PDS myself. All I know is when we're going to try and compare one fund to another, we need to add all of these additional things in, because the retail consumer looks on the Australian Super website and says, I'm in the balanced option, it cost me 0.6 to be in this fund. When in actual fact, when you add in borrowing fees, property fees, and where applicable, implicit and explicit fees, the costs are more like 0.79, or nearly 20 basis points more, that people need to remember get added or charged to the entire asset value of your portfolio. So it can make a significant difference in the underlying costs of the fund that you're in, for example. So there's some of the things that people need to think about. Some of the other fees that funds charge in relation to doing different things for members can also be super splitting. Some funds will charge a fee to do that, where you pass money from one spouse to another. Separation, when you're going to flag superannuation in relation to to family court and divorce. Some funds can actually charge a fee for that as well. So it's very important that people look at the fund that they're in and get a real understanding of the true costs of the fund that is charging them for different services. And then they can ascertain whether it's actually good value compared to the self-managed super fund alternative. And we can go through some of those comparisons in a little bit.
So the established industry fund that you're a member of might actually be costing you more than you think.
Yeah, look, exactly. You know, if we look at that, and for the sake of the example, I've said that the audit and accounting fee for the self-managed super fund is fixed at $2,500. Okay, so we've got a consistent. And I've also said, for example, there's $1 million in a super fund just to keep the numbers round. I looked at 3 or 4 different funds that are out there in the moment. Obviously, in the ACT, the PSSAP, the Accumulation Government Fund, their default option charges 1.21% as an internal cost ratio. The total cost when you add back some of the other fees is 1.41. So on $1 million, you're talking, you know, 14,100. All right. To invest the same amount of money in a self-managed super fund, you're looking at $7,000.
So quite a significant difference.
Yeah. So again, I've used, just for consistency, I've said the internal cost ratio of most self-managed super funds where you're in a diversified portfolio is about 0.45%. So we'd have $4,500 there. We'd have $2,500 of admin and compliance. That brings us to $7,000. That's $7,100 cheaper than the PSSAP government alternative. So that's one example where when you actually look at the underlying costs in totality, I think a self-managed super fund is very, very flexible in that regard.
Yeah, it obviously makes a lot of sense to examine these options when we might be paying more than we think in the fund that we're currently with. And the self-managed super fund, as we've discussed over the last 3 weeks, isn't necessarily as difficult to set up and run as people might imagine.
No, look, again, I think the best thing they could do for the self-managed super fund industry is change the name. Yes. I think that's the first point of fear. And again, you know, if we look at some other analogies here and say, okay, the balanced option at Australian Super, on $1 million, you'd be paying $7,900. On $1 million in a self-managed super fund, you'd be paying $7,000 by comparison. Now, obviously, one of the biggest advantages, as we've discussed in other episodes, is the fixed cost nature of a self-managed super fund. So as your value starts to grow, those savings or cost efficiencies start to get exponentially better. And I think I gave you an example last week. I had a client with a couple of $1 million at Australian Super. The net saving was $8,500 by comparison. So, you know, it starts to really pay to understand how to compare a fund and what you are really paying. You know, another example, Host Plus. You know, right. Host Plus, 1.21%. Okay, 12,100. $1 million in a self-managed super fund, save you $5,100 in fees every year.
Again, another significant saving. But if we move to an SMSF, are there any other costs that we should be aware of associated with that?
Yeah, look, potentially there can be, and it comes down to the structure and the setup of the fund. And what I mean by that is, obviously, if you have an accumulation account where you're adding money to super and you're drawing a pension out of the same fund, it sounds funny, but you can. It's one of the best structural flexibilities of this sort of super fund. You may require, or you will require, an actuarial certificate, and they can cost between $200 and $400 depending on the provider. And all that does is it confirms the tax-free proportion of the fund in totality. And it's something that's collected on an annual basis and will be completed by the accountant or the auditor. They would facilitate that for the members. Depending on the trustee structure, you may have the incorporated fees of a company, and where a company is acting as a trustee of the fund only and is not trading, the annual fee is significantly less than the standard registration of a company. But again, if you don't have a corporate trustee where a company is running your fund, if it's just you and I as the trustee, then obviously that's not an expense that you would incur. But they're two examples of, depending on how the fund is set up and what phase of life the fund is in, you could have some small costs that are required, obviously.
But that's the key point, isn't it? Those additional costs are only small ones. They're not much to worry about at all, are they?
No, look, exactly. Again, depending on the underlying assets, if you've got some weird and wonderful things in there, now by default, you may have some additional costs that a traditional portfolio may not. For example, if you've got a collection of wine or you've got paintings and they need to be professionally stored and insured, they're going to be ancillary costs that, because of the flexibility that you want in your fund and the assets that you hold, you may have some out-of-the-box expenses that won't be incurred on a traditional portfolio of assets that could be invested in the market.
2CC, it's 14 to 5, and I'm joined in this half hour by Luke Smith from Envision Financial, and we're talking about self-managed super funds. It's part 4 of our 4-part series on the topic, and we'll be back with more in just a moment. Between now and 5 o'clock, we're continuing our series on self-managed super funds. And in this section, we're going to ask whether or not a self-managed super fund is expensive. And Luke, we've decided that it's not, haven't we?
Well, again, I think you need to compare it on an individual basis, because from a case-to-case standpoint, obviously it'll be impacted by the value of your fund. Now, we need to keep in mind that these sorts of funds are obviously not appropriate for smaller balances. And I would advocate that people think seriously about opening a fund just for the sake of it because their mates have one. I think 2 things we need to compare are obviously the size of the fund and the comparison to the costs, because you're going to be up for the setup fees in the first year, as well as say $2,500 of admin and compliance fees ongoing. So you want to be thinking about, $400,000 to $500,000, or the ability to add to this very quickly with large sums of money where the value would grow exponentially in a short period of time to make it cost effective. But I think it's really important that people consider that and not just jump to it because everybody at the water cooler's got one.
Okay. So what are some strategies to keep in mind when we're thinking about how to invest within an SMSF?
Yeah, so obviously we need to make sure that we have the underlying asset allocation of the portfolio correct. That is obviously how you feel about risk and assets that will give you what you need to be able to do what you're doing going forwards. It's obviously very important to think about managing the internal cost ratio of your portfolio. So think about having some listed shares. Think about using exchange traded funds, because looking at the generic options of an industry fund, for example, may or may not, when all of the ancillary costs are added together, they would be appropriate for you from a fee-driven standpoint. So understanding how you build your portfolio for me is just as important as the total return, because as we've said in previous episodes, if you've got 2 cars that are the same model driving at the same speed, you should end up with a similar rate of return. But if we can lower those investment costs, a big consideration is that the admin fee of a super fund is deductible. The internal cost ratio is not. So if all of your fees are associated with the internal cost ratio, you're actually missing out on potential deductions when you compare a fund on a like-for-like basis.
All right, so it's a bit of a challenge to get your head around all this sort of stuff, but are there other strategy options that we need to keep in mind?
Yeah, look, another thing I'd consider obviously is then the underlying assets. If you want to hold some bespoke assets, it's obviously something that is one of the key flexibilities of this sort of fund. So when I mean bespoke, it could be paintings, it could be wine, it could be pink diamonds, it could be collectibles. Obviously, there are fees and charges associated with these different sorts of assets, because obviously there's very stringent rules around how things are stored, insured and maintained. But again, making sure that you have a fund that gives you all of the flexibilities that you're after can give you the control that most people seek in relation to a self-managed super fund, and ensure that the costs are representing good long-term value. Because in some of those examples that we talked about before the break, you add that up over 5, 6, 7 years, you're talking about a nice motor car.
Indeed. So now that we've reached more or less the end of our four-part series of self-managed super funds, before we wrap up today, I wanted to ask you about a story I saw on news.com.au, which says a new government incentive could help you save more than $5,000 in income tax, but it's only on the table for the 6 months. Now, what it's talking about is the initiative which allows people to access $10,000 of their superannuation this financial year if they need it due to hardship, and another $10,000 in the next financial year. But apparently this leaves a loophole where people can actually make a contribution of $10,000 now and withdraw it again almost immediately, and it's tax-free. How does that work?
Yeah, so really what we're doing is, or what people are proposing is, it's an old recontribution strategy where, for example, people over the age of 60 could withdraw money from superannuation via a pension, but put money into superannuation and claim a deduction. So with this loophole, it's obviously going to remove the need for people to be over preservation age, because it's opening up superannuation to everybody. And all they're saying is if you put money into superannuation and claim a personal deductible contribution, i.e. you tell your accountant that you're going to claim this money as a tax deduction under this one-off exemption that ScoMo has given us, obviously people can pull that out in relation to hardship and things of that nature. Is it in the spirit of fair play? You'd have to question whether it is, but it would give people the ability to pull money out tax-free after claiming a deduction in the same financial year going forwards.
Yeah, I wonder if maybe they might notice this loophole and close it fairly quickly. I don't know. It's one of those things that I think they probably didn't mean it to work that way, so they might change it at any moment. I don't know what you feel about that, but it might just disappear very quickly.
Yeah, look, I think, again, most of these things are there for legitimate people that obviously need the money to get by. And in an upcoming show, we're going to discuss the implications of that in a little bit more detail. Yeah. But I think in the spirit of the law, if you go to claim a tax deduction, now I'm not an accountant and I don't work at the ATO, but if you were looking at someone's financial situation and claiming these sorts of benefits, you don't want to be waving a big red flag anywhere in front of the ATO, because you don't know where that'll go. And they also may have the right to turn around and deny you the deduction. So I guess I'd just be mindful of taking advantage of something that, as you say, wasn't created for that purpose.
And so where can listeners get more information, Luke?
Yeah, look, obviously, we can go to the website, www.envisionfinancial.com.au. Obviously, we can ring the office and we can organise a Zoom meeting, because that's the flavour of the month at the moment, because we can't sit face-to-face. And the office number's 02-6260-4749. So we're operating as normal, maintaining normal business hours, and the girls are there servicing clients, and we're taking new appointments and just using technology to our advantage. Obviously, we've got the strategy stacker on iTunes, where we have the show, and we're about to start our understanding series, which will be a regular weekly Zoom meeting, which will be coming next month, and we'll talk about that next week. And obviously on YouTube, we've got Envision Financial Canberra, where you can pause the show and get the key takeouts and build on the strategies from there.
Marvellous, Luke. Thanks for that. And we'll chat to you again next week.
Pleasure. See you next week.